My clock shows noon, so I think it's time to get started. Welcome. I'm Damona Doy, and welcome to another Learn at Lunch webinar. We hope that you found them useful. If you missed earlier sessions on farm transitions or grain and market outlook, you can find them at our eFarm Management website listed here. So the series was designed to complement some online resources that we're building to provide what we call eFarm Management. We're adding new video and publications and spreadsheets for anyone wanting to learn more about financial management, and also have a concurrent initiative for an online course for producers who may need borrower training to qualify for FSA loans. So today's topic is equitable lease agreements. I'll briefly describe what lease agreements should represent, provide a bit of historical perspective on rates, and then describe 3 methods for arriving at an equitable rate. As one of the methods is looking at market rates, I'll spend some time looking at data from National Ag Statistics surveys and our recent rental rate survey that we conducted jointly with NASS, and share the results of those so that they can be used in informing negotiation processes. I want to begin by emphasizing that when I get calls or emails from people wanting to know what's the right rental rate for a piece of property, I always stress there's no one size fits all. Every property has different attributes, soil types, slopes, fencing, water, and so on. And so while the going rate may be a piece of information that's valuable in the process, we need to factor in and make sure that we're valuing all the contributions of the different parties. I'll focus primarily on pasture and crops, but the principles that we discuss are the same for livestock. At the end, I'll list some references that provide more detail on developing good agreements, some sample lease forms, and spreadsheet tools. I welcome questions at any time during the webinar. I'll try to watch the chat box for questions. And we have Shannon Farrell, our ag lawyer, on standby at the end in case there are legal questions that come up that he'd be better suited to answer. So in thinking about developing an equitable lease agreement, there's 5 questions that need to be asked and answered. It's not just how much rent can you get if you're the landlord, or how little can you pay if you're the tenant. So what portion of the income do I receive? It's not, for example, if the land includes wheat, are you sharing the grain crop, grazing income, baled straw, maybe hunting income? What portion of the cost do I contribute? With a cash lease for the landlord, it may be none. But if it's a shared lease, how are seed, fertilizer, fencing, harvest costs to be shared? It's likely going to be different for different items, for instance, seed and lime. What portion of the cost or the risk do I bear? Risk may be production, market, financial, legal, or human in nature. With cash leases, the tenant bears nearly all the risk and certainly all of the production risk. If a crop fails due to hailstorm or drought, the tenant bears the brunt of the damage while the landlord keeps getting a cash payment. What crop and land management practices will be followed? No-till or conventional till, cover crop, no cover crop, application of poultry litter or not? What will be the condition of the land and improvements at the end of the lease? Do you have to agree on the condition of fencing or buildings? Will soil tests be required to document that soil fertility has been maintained? Either cash or share lease agreements may be single or multiple years. In Oklahoma, most leases are annual, but they've also been in place on average for decades. Multiple year leases provide some security for tenants in that they can plan to make improvements and have more confidence that they'll expect a share in those benefits over time. So all of these factors, income, cost, risk, management practices, condition of the assets, are items that should be discussed in developing the equitable lease agreement. I think I probably learned this from Shannon Farrell or another of our ag lawyers involved in our North Central Farm Management projects, but I'm often asked about the fairness of a rental rate, and the lawyers say that fair does not equal legal, and legal does not equal fair. Economists would probably say that fairness, like beauty, is in the eye of the beholder. But clearly not fair would be things like not compensating the tenant for improvements that will stay with the land when a lease is terminated, things like lime, fencing, or buildings. Not fair would be mining the soil as a tenant, or not fair would be raising the rent because a new tenant's doing a better job of managing and getting higher yields. So the golden rule may be helpful in resolving disagreements due unto others, but it's important to think about as many different angles and potential problems in formulating a good agreement. So the best agreements are going to emphasize properly valuing the different contributions. Valuing contributions requires a bit of work, but that's really the only way that equity can be ensured. A bit of historical perspective on cash rent. So this is a series that's developed by USDA's NAS. And here you can see the gold line shows the non-irrigated cropland, so in other words, dry land cash rents over time. The green line shows the pasture cash rents. So you'll see, starting from the left, the run-up in cash rents associated with the golden period that preceded the farm crisis. Cash rents got bid up much more and also came down more sharply than pasture rents. Since the recovery from the farm crisis, we've had a slight trend upwards in cash rents, but a long period from, say, 1987, 88, where the pasture rents were fairly flat for about 20 years. After nearly matching the 1982 high state average cropland cash rent of $32.30, our average cropland cash rents dipped back down from $32 in 2014 to an average of $30 per acre in 2016. The state average pasture rent of $13.50 per acre in 2016 is past the 1985 high of $12.30 per acre. I took the county level data and looked at, for geographic regions, the changes from 2014 to 2016. So I'm not comparing county level 2014 to 2016, but geographic areas like the Panhandle to the southeast. And so if you look at the pasture land rental rate chart at the top left, you'll see that the rates in the Panhandle increased an average of about $1 per acre, and as you moved farther east and south, the increase was more than $1 per acre. And so in far southeast Oklahoma, for instance, the average increase in rental rates was about $3 per acre. Of course, native pasture is more prevalent in western Oklahoma with lower rainfall, and introduced pastures are more common in eastern Oklahoma. And so there's perhaps more cattle in eastern Oklahoma as well, and so that reflects the expected income associated with the cattle markets the last couple of years. The dryland crop chart at the bottom right has a different story. While most parts of the states had decreases in crop cash rents, the Southwest, on average, the blue at the bottom left, had no change, while the East Central counties had an increase of $1.50 per acre. In other areas, we had significant decreases. In Southeast Oklahoma, the average was a decrease of $5.50 per acre, with $4 per acre in central and northeastern Oklahoma. So I mentioned earlier that we talk about 3 approaches to coming up with an equitable rent. The first approach provides insights into what the landlord might want based on a return to equity and cash costs. The second approach is similar to that for land appraisal in that you use budgeting techniques to look at potential returns and ability to pay. The third is focused on market evidence of what might be labeled the going rate in an area. In other words, what's comparable land renting for. All of these approaches yield what can be argued are reasonable values, but they often yield different values, and that's the point of negotiations. So we'll start with the landlord's ownership cost plus return to equity. So if we estimate property taxes and other ownership costs such as maintenance of improvements, insurance, and depreciation, add to that an estimate of desired returns on investment. What's the right rate to use on the desired return? Well, probably something less than the stock market. but perhaps more than a CD. It's generally unrealistic to expect a 9% return on ag land, for instance, in Oklahoma. Here I've used 3% and the average value for cropland in southwest Oklahoma of $1,700, which yields a $51 desired return on equity. Adding a couple of dollars for property taxes would suggest a $53 per acre rent. That doesn't mean the landlord would get it, it just provides a basis for potential negotiation. And note we used ag valuation for land, not its potential for development or other uses. The second approach, the residual income process, essentially requires developing a budget that itemizes the expected returns and costs contributed by the two parties. Variable costs change with the level of production, while fixed costs are incurred whether or not production is started. So variable costs are things like seed, fertilizer, chemicals, fuel, harvest costs. They're fairly straightforward. The one challenging value might be assigning a value associated with the operator labor that's contributed. Fixed costs include insurance and taxes, plus ownership costs such as depreciation on machinery and equipment, and of course the opportunity cost on the value of money tied up in the assets. These are a little more complicated to calculate, so I've got some alternatives on the next slide. So one approach to valuing the contribution of machinery and equipment would be to have the owner prorate annual cost to the lease based on the portion of the total acres operated. For instance, if the total annual machinery depreciation, insurance, taxes, and interest on the average investment for an operator was $50,000, and the lease represents 10% of the acres farm, $5,000 would be included as the operator's value for machinery and equipment in the budget. But if it's difficult to allocate or calculate the fixed cost of machinery equipment, you could substitute the custom rate for the field operations for spraying and so on as a proxy. Management is also being contributed and so should be valued. A couple of approaches have been used historically where you look at a percent of the average capital invested or a percent of gross farm receipts. The management fee could be a fixed amount. A common range that I've heard on management fees based on gross farm receipts is 5 to 8%. When estimating the opportunity cost on funds invested in agricultural assets, think about what those assets could earn in a similarly risky environment or investment. One option is to use the interest rate on CDs, add a risk premium appropriate for the ag enterprise, and then subtract the expected appreciation in land value. So if CD rates are 2%, the risk premium is 3%, land is expected to appreciate 3%, the opportunity cost interest rate would be 2%. Another alternative is to use what's labeled the capitalization rate, which is calculated by dividing the annual cash rent by the per acre land value. So if cash rents are for comparable land are $40 an acre and the land's valued at $1,700 per acre, the capitalization rate would be 2.3%. It's important to take into account the value of the land contribution and the differences in the quality of land. So good rich loam soil that doesn't flood contributes much more to potential profits on the lease than sandy soil that blows. This graph illustrates the point. Costs of putting in a crop are essentially the same regardless of the quality of land, and that's reflected in the flat dashed blue line. Better soils in higher rainfall areas have much greater yield potential, so higher possible gross revenues. So landowners with high quality land might reasonably expect a greater percent of the crop, or they may want to contribute less to variable costs. The OSU Ag Budget website has a variety of templates for major commodities that may be useful to you in evaluating residual income. Numbers can be customized to match an individual farm situation. If records show higher average yields, for instance, or you earn more from small grain pasture, you can make the necessary adjustments. In this example, you'll see that the returns above total operating costs at the bottom are negative. so even without a charge for land due to low anticipated market prices. I think in this case I used the low end of Kim Anderson's projected price. This would suggest that no payment could be made to the landlord, which of course isn't realistic, but if it's expected to be the case in the long run, might suggest letting a lease go if this is the outcome, or considering an alternative crop with potentially better returns. At the bottom of our budgets, you'll also see that there are useful tools that highlight break-even prices and yields, which can be helpful in managing as well. In this example, the break-even yield at $3.50 per bushel is 45 bushels, and the break-even price for 35 bushels an acre is for almost $4.50 a bushel. We mentioned market price as a source of information in negotiating equitable leases. The source that I referred to earlier, the NAS data, has been available annually, but is until 2014 as a result of the 2008 Farm Bill. It's going to be biennial going ahead, so every 2 years. You can look at other public sources as well. The School Land Commission's annual auctions, for instance, are a source, but you want to look for things that are local in nature if possible. I put together this data visually in the charts on the next slide to highlight the variability in the cash rental rates across the state as reported by NAS. In the chart at the top left, you have cash rental rates for non-irrigated cropland, and you can see the highest rents are in our most productive areas in north central Oklahoma, so Woods, Grant, Alfalfa counties, and so on, where our wheat yields are the highest. Also some high rents along the urban areas along I-40. So in contrast, at the bottom right, you've got pasture rents, and there the highest rents are in northeast Oklahoma. Again, you can see variability in both the cropland and pasture rent rates with ranges from $8 to more than $36 for cropland, and from $5 to more than $30 in the pasture cash rents. We do a survey in conjunction with NAS as well, and so we don't get nearly as many responses to the surveys, and so we report for broad geographic regions, but we do report some differences for types of pasture and so on. So we have eastern Oklahoma is basically east of I-35, north central, northwest, and southwest. We published the results of this survey just recently. Our surveys were mailed out last fall, and so data would have been collected later than the NAS survey, and so we see a bit higher rental rates, for instance, in the crop for cropland than we saw in the NAS data. In this slide, and the results of these are published for the cropland in OSU Current Report 230, which is available on the OSU Facts website, and for the pasture rental rates are in Current Report 217. The numbers on the top line in each row show the average for the responses. The numbers below the average show the median value for the responses. And so, for instance, in the average acres in the lease, 540 was the average, but 177 was the value that was in the middle of the responses. So in other words, about half of the responses reported leases smaller than 177, and half of them reported a size larger. The state average rental rate for cropland and wheat was $36 per acre, up slightly from our survey 2 years ago, and for alfalfa was about $47, down a bit from 2015. Typically, the spread between wheat and alfalfa ground is about $12 an acre, so this is a bit of a narrowing in that range. While the average cropland rental rate for north central Oklahoma is $39 per acre, the survey responses vary quite a bit. This emphasized that the average provides a piece of information, but it may not necessarily be the right rate for any specific piece of property. And this next chart shows the wide range of responses to the cash rental rate question in our survey without revealing any individual responses. Recall that our average rental rate was about $36 an acre. The most frequent response is in the $30 to $40 range, but a quarter of the responses are below that and 40% are above that. 19% reported rental rates of more than $50 per acre. So again, a lot of variability in the responses reported. Shifting now to pasture, current report 216 summarizes this and more about the pasture rental market. We have more responses for native pasture than for wheat. The state average for native pasture was about $14 per acre, with the highest rates in eastern Oklahoma and lowest in northwest Oklahoma, where of course lower rainfall limits stocking rates. For Bermuda pasture, the average was $22.79. For the state, a little less variability in those values, with the southwest low and north central being the high in that range. For other pasture, Old World Blue Stem is the dominant species in western Oklahoma, and fescue is in eastern Oklahoma. The native or the introduced species commands higher rents than native pasture, which is not surprising since the stocking rates are typically higher with those. A perspective on the range of responses received with respect to native pasture, again to emphasize that there's not one rate that fits all situations. Here, 40%, 43% responded with a value that fell in the $10 to $15 range. Had relatively more responses above that than below that, kind of a normal looking distribution here, but 17% did report a rate above $20 per acre. The Bermuda pasture distribution was a little more wonky, so a lot of different responses here, not a normal looking distribution. About 30% falling in the $12 to $16.99 range, another 28% above $27 per acre. So to summarize the kind of three approaches that we looked at for developing an equitable cash rent for a piece of property valued at $1,700 in southwest Oklahoma, we looked at what the landlord might want. We came up with $53. We looked at the budget approach and saw that this year there's not much profit to be generated, which would limit the tenant's ability to pay a high rent, and the historical going rates are in the neighborhood of $30, $50 to $31 per acre. So these numbers provide the basis for negotiation. The challenge again is to identify the characteristics of the parcel and what might make it different from other comparable land. And so negotiation skills are really important. Shifting from cash rents to equitable leases, let's briefly discuss best practices for an equitable share rent agreement. The bottom line, of course, is that the share of the return should match the share of total variable and fixed expense. Variable expenses are things like seed, fertilizer, fuel, and so on. Fixed costs, again, are insurance, taxes, and depreciation on machinery and equipment and more. You've also got to value labor and management. But a key point with the variable expenses is that you want to have the incentives aligned with profitability. So you want to share fertilizer expenses, for instance, as fertilizer's yield enhancing. You don't want high fertilizer prices to result in skimping by a tenant on needed plant nutrients, as that might limit yield, which results in revenue losses that exceed the cost saving from skimping on fertilizer. Typically, the tenants providing the machinery, equipment, labor, and management. We briefly described the approaches to valuing those contributions. You can find more detail in the reference publications that I'll list at the end. But another important point with share rental agreements is that as technology changes, the lease parameters may need to be adjusted. For instance, a shift to no-till may increase variable costs such as chemicals and application of cost. and reduce the labor required. So the resulting trade-offs may mean that your share percentages need to be adjusted. Finally, it's important to have provisions in the lease that compensate the tenant for any improvements made during the lease agreement, particularly if those improvements remain with the land when the lease ends or is terminated. For instance, if a tenant puts down lime that's expected to yield crop benefits for 5 years, and the landlord opts not to renew the lease at the end of 3 years, the tenant should be compensated. At a minimum, the tenant should be repaid 40% of the cost of the line application, but could argue for a bit more since the yield might have been higher for the landlord during the preceding 3 years as well. The results of our rental rate survey show our share lease agreements different from those in the Corn Belt, for instance. The landlord typically gets a third of the crop here, as well as a third of the government payments and other income. They share in a third of some of the variable expenses. Here, the tenant pays seed and harvesting expenses. The majority of the respondents noted that the landlord paid a third of pesticides, chemical applications, and lime applications, but a significant number noted that the tenants paid 100% of these expenses. We've got some graphs to show the variability again in those responses. So this shows, for example, that 55% of the respondents said that the tenant paid 2/3 of herbicide expenses, but 35% said that the tenant paid all of them, and a few others had some different splits. When it came to lime, there's even a wider range in terms of the responses. The results are more mixed, with 17% saying the tenant paid no lime expenses, 49% saying they paid 2/3, and 30% saying that the tenant paid all the expenses. The important thing from an equity perspective is that in the final account, the contributions in total align with the share of the receipts. So both parties, tenants and landlords, can benefit from estimating their contributions. This serves as a tool not only for communication, but a platform for negotiation. So again, use of area standards or traditions may be valuable as an information source, but there is no one-size-fits-all. Just using the going rate doesn't necessarily serve the best interests of anyone. We have worksheets and spreadsheets that are available to summarize contributions and help people analyze alternatives. Fair doesn't equal legal. Legal isn't necessarily fair or equitable. It just is. So weighing carefully what you want in an agreement and negotiations are important. Putting the agreement in writing is really important. There's all sorts of reasons to do that. It serves as a memorandum of understanding. It forces the parties to think through the terms and agree on what makes sense. It provides legal protection in the event of death or disability or some other unexpected event. If you anticipate needing or wanting a change in the lease, start discussions early. Nobody likes last-minute surprises when it comes to business deals. Be sure to update the agreements periodically as circumstances change or the economic environment changes. When making decisions with legal repercussions, it's always a good idea to consult with a lawyer, even if it costs money. Just give a lot of thought to it before you make an appointment so that you minimize your billable hours. Here's the list of resources that I mentioned. Because of the frequency of lease-related questions, extension specialists have collaborated in developing publications focused on developing leasing agreements for cropland, pasture, livestock, buildings, machinery, and equipment on the Ag Lease 101 website. On the same site, you'll find lease agreements with downloadable, fillable, free forms so that you truly have no excuse not to put an agreement in writing. Reviewing it will remind you of parameters that you should think about, even if the other party insists on an oral agreement in the end. Economists and production specialists here at OSU have collaborated in creating the aglease.info website. So it's got both production and farm management information. The Budgets website has free downloadable templates to assist you in analyzing potential returns and studying what-ifs. Publications in the OSU Facts website have our rental rate survey results, current report 216 and 230, with the survey results that I shared. There's also publications to highlight tax aspects of leasing and provide tips on negotiating. The NAS website has the information on the county level rates that I showed in a number of slides here. And so with that, I'll be happy to answer any questions that you have. And again, if you've got legal type questions, Shannon's also available to answer questions. While we're waiting to see if any questions are submitted, I'll remind you that we'd like to have you fill out an evaluation of this survey to suggest other ideas for future topics. Brent has provided the survey link in the chat box at right. So please take a moment. It's a really short questionnaire, just a couple of questions, but we appreciate your input and feedback. If you found this helpful, encourage others to watch it. It will be posted on our webinar site, and so others may choose to watch it later. Any questions? Of course, you can always email later or call later if you have questions. We appreciate your participation today and look forward to connecting with you again later. Thanks for participating.